on down to the Federal Reserve Pawn Shop. It's permanent repo madness, effective at the next Fed meeting. Up to $100 billion per day. 14-day term loans of up to $60 billion. Not good collateral? No problem. Free pickup in hazmat or radiation suits. And don't forget, we offer full privacy and discretion. None of those silly audits. We'll pay full price. We'll overpay. Repo madness is the best. Repo madness will continue forever. And remember, repo madness is not QE.
So a permanent repo facility is being discussed ad nauseum now. It is truly repo madness. Not only is it the large Wall Street investment banks, so a lot of Wall Street banks are discussing this, expecting a permanent repo facility in the very near future implemented by the Fed, could be announced at the next Federal Reserve meeting. So a permanent repo facility of $300 billion minimum being discussed. I've seen estimates between $300 and $500 billion. There was an article out with research from Morgan Stanley Investment Bank saying the Federal Reserve asset purchases will likely total $315 billion over the next 6 months as it seeks to stabilize overnight funding markets and contain the movements of its target interest rate, according to projections from Morgan Stanley. Bank of America has very similar projections. And Goldman Sachs and other investment banks as well are seen to be falling in line that first what will happen is there will be a permanent repo facility, a larger permanent repo facility, and then we will get QE shortly after that. That seems to be what a lot of large Wall Street investment banks are saying, although it sounds like the initial QE may be smaller than what we're used to in the past. It may only be, in air quotes, 20 or 30 billion per month. Good stuff, right? The next Federal Reserve meeting is in October. You can just Google it and look it up exactly. Repo is a bailout. So we are now openly discussing permanent open market operations, or POMO, which is a precursor then to QE. So the Fed will argue, and Wall Street people will argue, and Danielle DiMartino Booth will argue that this is not QE, even though she just interviewed another former employee at the Dallas Federal Reserve Bank that was released on Real Vision TV on Monday behind their paywall. And for the $180 per year for the subscription, this interview might be worth it just for that. This guy's name is George Goncalves, and they were joking about how to rebrand QE. So the average person would be fooled. So it would be easier for the Fed to get away with it. They were talking about guaranteed a permanent repo facility. They were talking about secret Fed meetings that the people would not be aware of, that so they could discuss things and not release things publicly. Just the normal everyday business stuff that's been occurring for the last almost a year now, since that weird Christmas Eve meeting that Steve Mnuchin put out a press release announcing that the plunge protection team, the Federal Reserve, the Treasury Department, and all the other alphabet soup of regulatory agencies were going to meet when the corporate bond markets almost broke. They were cracking up. There was a long period of time after General Electric, and then we had a stock market sell-off that almost caused an enormous collapse in index funds. There was almost a run on index funds. So the Federal Reserve actually predicted the problems in the repo market. This might be the one time the Federal Reserve actually was right about something. There was a research report written on Wednesday, March 6th of 2019 on the St. Louis Federal Reserve.org website. I have a link to it. It's as part of their On the Economy blog, why the Fed should create a standing repo facility, by David Andolfato and Jane Ihrig. So the Federal Open Market Committee is locking down its long-run monetary policy implementation framework. We know it will consist of a floor regime characterized by ample supply of reserve balances. There is a lot of reserves in the system. The problem is, why were those reserves not lent out? Why did, in the overnight repo markets, banks decide that they didn't want to earn an extra, at one point it was more than 2.5%. They decided that they didn't want to risk that extra, earning that extra money for overnight lending, even with potentially quote unquote good collateral. And that's why they're talking about this permanent repo. So there's ample reserves in the system now, but they're not being lent out. Ample reserves in the present context means the minimum level of reserves necessary to permit the efficient and effective conduct of monetary policy through the use of the Federal Reserve administered rates within the active management of the supply of reserves. So market participants are projecting ample reserves in the $1 trillion range, a level much higher than their pre-crisis average of only approximately $20 billion. So the reserves are much higher than they were prior to 2008. The reserves in the system now. And actually, I think I just saw a Zero Hedge article earlier today saying that Goldman Sachs and others were projecting the reserves to actually climb to 1.7, 1.8 trillion. And here we are, in addition, with the reserves that high, the banks still don't want to lend. Even though the repo markets were undersubscribed on Friday, that doesn't mean that something crazy is not happening over the weekend. That does not mean that there won't be an oversubscription like there was earlier this week, where the Fed had to step in again and increase the amounts of the repo program from 75 billion, which was oversubscribed, to 100 billion, and then increase the 14-day term repo borrowings from 30 billion to 60. Crazy stuff. So this is truly repo madness. In fact, there is a lot of worrying going on. There was a op-ed by the former Minneapolis Federal Reserve Bank president, Naranja Kocherlakota. And he wrote this a few days ago on September 25th, and he wrote an op-ed for Bloomberg, Why I'm Worried About the Repo Market. So this is not hyperbole. This is not some of the stuff in the gold community. This is directly from a former Minneapolis Federal Reserve Bank president, this article. The recent unrest in money markets, which briefly caused short-term interest rates to get out of the Federal Reserve's control, won't undermine the central bank's ability to achieve its longer-term economic goals. That said, it does signal that something's very wrong with the financial system. To understand what's going on, let's return to a simple model. Suppose there's only one big bank. It has a choice of what to do with most of its assets. It can keep them on deposit at the Fed, earning the interest rate that the central bank pays on excess reserves, or it can take more risk and earn more return by investing in securities or loans. In this world, all the assets earn the same quote-unquote risk-adjusted return, which the Fed effectively determines by setting the interest rates on excess reserves. Now let's take a step closer. This is all central planning and creating enormous distortions, but let's just finish the article and then I'll analyze more of it. Now let's take a step closer to reality. There are two groups of banks, quote, tight ones that hold few excess reserves, and, quote, flush ones that hold a lot. Flush banks can lend reserves to tight banks in the federal funds market, a focal point of the Fed's monetary policy. As long as this lending happens freely, all assets will still have the same risk-adjusted return, and the one-bank model will still be a good indicator of how the many-bank world will respond to the Fed's policies and to various shocks. In recent days, though, that crucial free lending condition hasn't held. On the contrary, a convergence of events, a deadline on corporate tax payments, which I don't believe this deadline on corporate tax payments, and the settlement of a big treasury auction created a sudden and severe shortage of reserves. This is the false narrative, I would say, that they're blaming it on corporate tax payments. I don't believe it. As a result, interest rates diverged sharply in markets where they should be the same. In the repo market, where participants borrow and lend against the collateral of treasuries and other securities. In 2007 and 8, it was worse than quote-unquote good collateral. They shot, and the banks didn't buy any of it back. And they still pledged, and the Fed still took the collateral, and then that's why TARP programs and QE had to increase. They shot up above 5%. Actually, they went up fourfold. They went up to emerging market levels, almost at, 10%? So they went up from the 2-something range, 2.25 range, up fourfold to around 10. And in the federal funds market, they breached the upper bound of the Fed's 2% to 2.25% target range. The deeper issue is that since the 2008 financial crisis, regulatory reforms such as requirements that banks hold a certain amount of liquid assets and maintain a minimum leverage ratio, equity capital as a percent of total assets, have constrained the ability of flush banks to lend and of tight banks to borrow. Actually, I don't know about that. They're saying it's all regulatory. No, the banks just decided that they'd rather take their interest on excess reserves for now. They'd rather earn that than take the additional risk. So I don't know if you can blame all this on regulatory. The banks have just decided through bad incentives through the Fed, by the Fed paying interest on excess reserves, by giving the banks all this extra money, and then the banks get all these extra profits. Danielle DiMartino Booth talked about how for some of these large U.S. banks and the 4 large U.S. banks, she said that 20%, according to her, 20% of their total net profits are interest on excess reserves. So it would make sense that they wouldn't want to risk that. And now you have a lot of new people that Trump may be putting at the Fed talking about eliminating interest on excess reserves, which were a large chunk of the bank profits now. Okay, so back to the article. Such constraints interact in complicated ways with financial market conditions. For example, European banks must report their leverage ratios as of the last day of each quarter, so they reduce their repo activity to make those ratios look better. As a result, even when excess reserves seem abundant, funding costs for banks may exceed the interest rate that the Fed controls. This isn't necessarily a problem for the Fed's monetary policy, because the central bank can inject cash into various markets to bring interest rates into line. And yes, no one should have this much power over interest rates. Certainly not 12 PhD academics, mostly academics with PhD degrees, who have a track record of fuck-ups or screw-ups, who have a track record of total screw-ups, and they are not held to account. They have no accountability whatsoever for all their mistakes. And yet they continue to wield enormous power controlling interest rates, which are the cost of capital is probably the most important thing in the entire economy. If they manipulate interest rates and screw up interest rates, it creates just unbelievable amounts of distortions and shock waves throughout the economy, chain reactions throughout the entire economy. So that's precisely, this isn't necessarily a problem for the Fed's monetary policy. Yes, it is, because the central bank can inject cash into various markets to bring interest rates in line. That's precisely what the Fed has been doing in the repo market, and it can make the fix more permanent by creating what's called a standing repo facility, which means the Fed will inject sufficient funds every day as needed to ensure that the federal funds rate stays in what it deems the appropriate range. Okay, I'm almost done with this. What's harder to understand is how money markets will respond to future shocks. As the experience of the past couple weeks has shown, the simple single bank model no longer works. Reserves are siloed in the flush banks, so the financial system is acting more like it has 1.3 billion in excess reserves than the actual 1.3 trillion. The design of regulation has disrupted some of the system's most basic functions. No, it hasn't, because the banks are getting paid enormous sums of interest to not lend. That's not regulation. That's the banks saying, hey, the Federal Reserve is the parasite that is the Federal Reserve and the large banks. This parasite's handing us more freebies. The people who oversee it all should be far from sanguine about what the repercussions might be. So I read you the op-ed, the short op-ed there from the former Minneapolis Federal Reserve Bank president. Back to this research report now from March. So reserves as high-quality liquid assets, converting treasuries to reserves through a standing repo facility. Here's probably the most important thing. These banks would presumably not want or need, okay, it's making 700, they're making an estimate here of 784 billion in precautionary reserves to cover their immediate liquidity needs in times of stress. These banks would presumably not want or need around 800 billion in reserves if higher yielding treasuries could be liquidated at a modest discount on a reliable basis in times of stress. The Fed could easily incentivize banks to reduce their demand for reserves by operating a standing overnight repurchase or repo facility that would permit banks to convert treasuries to reserves on demand at a administered rate. So Danielle DiMartino Booth, in her own words on that World Vision television interview that's behind the paywall, released on Monday, called this permanent repo facility that will most likely get implemented very, very soon, potentially as the next Federal Reserve meeting, it will be announced, this permanent repo facility. And it's also been discussed in the Fed minutes in, I believe, the June and July meeting, and the Fed minutes are heavily edited. So the Fed can choose what we see and don't see in the Fed minutes. And she called this permanent repo facility, and the other former Dallas Federal Reserve Bank employee called this, quote unquote, QE on demand. And this is what the research report says. That would permit banks to convert treasuries to reserves on demand at an administered rate. But in public, they're saying it's not QE. And Danielle DiMartino Booth on the interview says it is. This administered rate could be set a bit above market rates, perhaps several unless she was joking. I don't think she was joking, though. You can listen to the interview for yourself if you have the interview behind the pay. If you have a subscription to Real Vision Television, they may release it eventually, but then you're going to have to check the date when they release it, because a lot of people think that the videos that Real Vision releases are brand new, and it says new on the YouTube counter, but you actually have to look in the information and description section to see when they were filmed. Okay, so permit banks to convert treasuries to reserves on demand at an administered rate. This administered rate could be set a bit above market rates, perhaps several basis points above the top of the federal funds target rate, so that the facility is not used every day, but only periodically when a bank needs liquidity or when market repo rates are elevated. So with this facility in place, banks should feel comfortable holding treasuries to help accommodate stress scenarios instead of reserves. The demand for reserves would decline substantially as a result. Ample reserves, and therefore the size of the Fed's balance sheet, could in fact be much closer to their historical levels. So in spite of around 1.4 trillion in reserves, the banking system needs an additional large permanent repo facility. So that should be another red flag. And then you have in these latest investment bank research reports that are coming out in the last day or two, you have them predicting QE could start as early as November in addition to the permanent repo facility. And they're predicting small QE. I think I've seen estimates of 300 billion on the low end. So with this facility in place, banks should feel comfortable holding treasuries to accommodate stress scenarios instead of reserves. The demand for reserves would decline substantially as a result. Ample reserves, and therefore the size of the Fed's balance sheet, could in fact be much closer to their historical levels. I don't think so. The Fed's balance sheet is going to have to increase. Why? 3 letters. CLO. Collateralized loan obligations. A lot of these things are completely and totally worthless. So I think the Fed has set the ground for, with the permanent repo facilities and for potentially the next QE, they're going to have to buy up almost all or all of the CLOs. Wow, lots of trolls today. Okay, back to this St. Louis Federal Reserve Bank article. Lending to banks in good standing. There are several other reasons why introducing a standing repo facility makes sense. First, as discussed here, it is a way for the Fed to lend cash to banks that are in good standing and have high-quality treasury securities as collateral but may find themselves short of cash. Importantly, this facility would not suffer from stigma problems that make the discount window an ineffective tool in these circumstances. So in theory, this sounds nice that they're going to take only U.S. treasuries as good collateral. But in reality, that's not what ended up happening prior to 2008. What ended up happening in 2007 and 2008 is the Fed started not taking bad collateral, stuff that wasn't good collateral. They started buying up Fannie and Freddie stuff. They started buying up mortgage-backed securities. Go and look at the charts of the spikes in the repo amount, where the repo amounts in 2007 and 2008 went up about fourfold from normal $100 billion per month levels to $400 billion or higher. And it looks like if you annualize the amount that's happened in repo in just the last 2 weeks, I think we're over those levels in repo. Now, technically, those are all paid back after each day. However, we don't know that for sure because there are no audits. There is no transparency, and we don't know if they're taking the good collateral. Tall Dog says, if there is no audit, how do we know what they're really taking? And this is why in the parody, if you go back and listen to it, I was joking about silly audits. We don't know. Anyone who assumes that they're only taking treasuries, first of all, there's a chart of the total amount of U.S. treasuries that primary dealers own, and the net amount of U.S. treasuries officially I've seen that all the primary dealer banks in the U.S. own is only a little bit over $300 billion. So if they only owned collectively, all the large primary dealer U.S. banks only collectively own a little over $300 billion in U.S. treasuries, it's not possible for them to only post all of those treasuries as good collateral when look at all the total amounts of repo. The total amounts of repo that have occurred in just the last couple weeks are more than the 300 billion. Now that money has been paid back, so they say. So they say every night the money is paid back. So they say. I don't trust any government or any bank without an audit. Thank you for the super chats, Mark and Dimitri. Dimitri asks, how will this permanent repo facility affect movement towards zero interest rate policy and negative interest rate policy? Well, the fact that they're putting in these permanent repo facilities means that something either in the over-the-counter derivatives market or leverage loans or corporate bonds, junk bonds, something is going bad. So something very serious could be counterparty risk with European banks, could be the banks in Europe that have American subsidiaries that sold derivatives to China, could be a bunch of factors. The bottom line, Dimitri, is they're going to have to go to zero interest rate policy because the corporations have overborrowed and there's all these zombie corporations. Zero interest rate policy benefits these overly indebted governments and these overly indebted large corporations the most. And that's why they're trying to prevent more General Electric scenarios from accelerating. So if interest rates were to spike and corporations were not able to refinance, there would be a lot more General Electric problems. And I'm not talking about any of the allegations that Harry Markopolos alleged. General Electric has had problems before that report came out last month. Just crazy stuff. So zero interest rate policy benefits the most. It benefits large governments, overly indebted governments like the US, Japan, European Union, and it benefits large corporations that have overborrowed. Look, I don't agree with everything Danielle DiMartino Booth says, but I think she provides useful information. Her Hedgeye interview is very good. There's a lot of difference between her Hedgeye interview that was released this week and the interview from Real Vision TV that's behind the paywall. So if you have access to the interview behind the paywall, contrast that versus the interview she gave to Keith McCullough at Hedgeye. I think there's quite a bit of difference. I agree there is no way that they can absorb all those derivatives, but they will issue a press release lying to most people and saying that they will guarantee the derivatives. And a lot of financial professionals want to believe that because their salaries depend on it. I don't know if all of Danielle's information is controlled. I don't know. No, she speaks her mind. I don't agree with everything she says. I think she just believes she's mostly normal Republican. I think she doesn't want the Fed ended. She wants the Fed reformed. Winging It Tracy says, repo madness money created from nothing to buy something that technically does not exist. Essentially, yes. And according to the charts I've seen, like I said, from the primary dealers who own a massive amount of U.S. Treasuries, they only have a little bit over $300 billion in Treasuries. That's what I've seen. That's the most recent chart I've seen. So unless that number's wrong, unless they own a lot more, hundreds of billions of dollars more in the hold-to-maturity accounts that Victor Sprondio has been writing about and doing interviews about for a year now, then the only good, quote-unquote, good collateral that the large banks have is only around $300 billion. Okay, let me continue with this St. Louis Federal Reserve article. This is going to be a shorter show today. There are CNN articles that are quoting Danielle DiMartino Booth and Peter Bookvar if you want to read more about it. That nothing was really fixed with the repo stuff. That yes, it temporarily delayed some type of crisis, but nothing was really fixed. Analysts are saying the Fed is likely to prevent further liquidity squeezes by either creating a standing repo facility or by agreeing to increase the size of its balance sheet again. Bank of America estimates that the Fed may need to boost its balance sheet by $400 billion over the course of a year to address funding pressures. There was oversubscription on Wednesday of the 75 billion repo, 92 billion in offers, showing an extreme lack of available dollars. Strategist. Okay, this is an interesting quote here from an Axios article. Axios is mainstream, but this is interesting. Strategists who have spoken with Fed officials are expecting the central bank to unveil a 300 billion to 500 billion standing credit line, so this is the permanent repo facility, to the market at its meeting next month in order to provide consistent liquidity and keep the market functioning. Okay, and here's the reason why why repo facility in the research paper from the St. Louis Fed, why they're saying it's important. There are several other reasons why introducing a standing repo facility makes sense. So the Fed actually predicted this in March. Shockingly, they may have actually gotten something right, that this was going to happen in the repo market. First, as discussed here, it is a way for the Fed to lend cash to banks that are in good standing and have high-quality Treasury securities as collateral, but may find themselves short of cash. Importantly, this facility would not suffer from stigma problems that make the discount window an ineffective tool in these circumstances. It would also be better PR than labeling something quantitative easing. And Danielle DiMartino Booth and George Goncalves, in that interview on Real Vision TV behind the paywall, were talking about how the Fed needs to rebrand quantitative easing to something else to confuse and obfuscate what it really is to most people. They may have been joking about that. It didn't sound like that to me, but they may have been joking about that. They were laughing when they were saying it, but I think there was truth in jest. So complementing overnight reverse repo facility. Second, the facility should be thought of as a complement to the existing overnight reverse repo facility, which sees take up with market conditions, financial market conditions. Together, these two facilities would create the standard deposit and lending tools used in typical floor operating regimes, such as the European Central Bank, eliminating need to estimate ample reserves level. Third, a repo facility would eliminate the need to make a judgment about the level of reserves likely to be ample. The interest rate ceiling established by the repo facility implies that the Fed can retain interest rate control independent of any shock to reserve demand or to the Fed's non-reserve liabilities. As reserves drain from the system, the point at which they become scarce would be demonstrated by a market signal. The federal funds rate and other money market rates would move up relative to the target range. At this point, banks would start to use a repo facility, which would automatically inject reserves into the system and prevent rates from rising any further. That is, the facility would ensure there were ample reserves in the banking system and preserve interest rate control, while at the same time allowing the Fed to safely discover the lower end of ample. Minimizing payment on interest on reserves. Finally, apart from being consistent with with the normalization policy and principles of 2014, a repo facility would minimize the politically bad optics of the Fed paying interest on reserves, of which a large share goes to foreign banks and foreign central banks. It seems both wise and proper to let the Treasury directly bear the interest expense associated with the regulatory demand. Even though balance sheet normalization was underway in March and now is over, they think it is never too late to introduce a repo facility. I added how the balance sheet normalization is over. The FOMC would learn, because now the balance sheet is actually starting to increase in small amounts. It increased like a couple weeks ago, $14 billion. $14 billion on a almost $3.8 trillion balance sheet is not that much anymore. The FOMC would learn over time whether the facility is working to reduce the demand for reserves. The FOMC could do so, for example, by permitting reserves to run off organically. Yeah, nothing that's happening, guys, is organic. With the growth of currency in circulation, nothing the central banks are doing is organic. Growth of currency in circulation while remaining confident that interest rate control would be maintained through the repo facility. The rest of it is gobbledygook and citing other research papers. Okay, I'll quickly take a look at listener questions and comments. But there's a lot of research now, like I said, coming out from whether it's Danielle DiMartino Booth and the other Wall Street investment banks and large banks, that they're expecting this permanent repo facility as soon as October's Fed meeting. And then potentially after the permanent repo facility is established, QE could come a month later in November. I ran a parody commercial at the beginning, so go back and listen to it. I was joking about silly audits and other stuff in my goofy, cheesy car salesman voice. Joni says Operation Repo is a bailout in front of our eyes. I would agree. And we have no proof that good collateral is being used. Not without an audit. Anthony thinks it's the beginning of the crash of 2021, so Anthony thinks that they will delay things until after the 2020 election. I think that is a fairly high probability. Just my opinion, not financial advice. And gold and silver, of course, get hit, but I think smart money is buying the dips because they see all these stupid things. Yep, crack up boom. Like Von Mises predicted, unpredictable asset inflation and deflation and distortions, and also the Cantillon effect, which means that this monetary inflation and credit, you don't know where it's going to go, and it's not going to raise all prices of assets or consumer prices evenly. So prices on some things are going to go up a lot. Prices on some things are going to go up a decent amount. Prices on some things are going to go up little or not at all. Well, there's the money velocity is actually falling here in the United States still. So more likely it's just going to be worse stagflation for the foreseeable future. A lot worse. And then new taxes. So I call it stagflate and tax and lie. Oh, thank you for the second super chat, Dimitri. VIX explosion in QE4. Dimitri, the VIX is extremely manipulated. So I know Jeff Gunlock talks about the VIX going up, but if you look at the history of the VIX only goes up a little bit and then it gets whacked back down like whack-a-mole. So you cannot buy and hold the VIX and expect it to go up and get rich that way. Again, this is not financial advice, just my opinion. So if you get a big spike in the VIX of 20 to 40% and you're trading the VIX, you may want to take a profit. And this is because, are you familiar with Christopher Cole of Artemis Capital? He's done a lot of interviews on Macro Voices. So go and listen to the archives. He's done a handful of interviews in the last 3 years on Macro Voices. And he also has slide deck presentations. You may be able to get emails of those. And this leverage short volatility trade, about 3 years ago, 2 or 3 years ago, it was over $1.5 trillion in size. And now it's probably even larger than that. And that's why the VIX doesn't stay high for long periods of time. Okay, this is not financial advice, but just my opinion. But what Anthony said is probably a decent idea. If you trade the VIX, you need to close as soon as you get that big VIX spike. So I would research, Dimitri, I would research the leverage short volatility trade that Christopher Cole is talking about. Danielle DiMartino Booth did a presentation on the CFA Institute. It was released recently, I think, on her YouTube channel. And it was filmed, I think, in July. And she talks about the leverage short volatility trade in there in Christopher Cole. You may want to go and listen to that. So Wall Street likes playing whack-a-mole, the adult version, the Wall Street trader version, the Wall Street hedge fund manager version of whack-a-mole. And every time the VIX pops, it just gets whacked right back down. So if you go and look at the chart of the VIX, it pops and then it crashes within a couple days after it goes back up. And that's because the manipulation, part of the manipulation is this leverage short volatility trade. And we may see eventually a long-term capital management blow up. There may be a few hedge funds out there that are ridiculously over-leveraged on this leverage short volatility trade. But from what Christopher Cole was saying, a lot of participants are involved in this, including pension funds and others, to try to get extra income that are shorting leverage short they're shorting volatility in commodities. They're shorting volatility in stocks. They're shorting volatility in a lot of other things. And they're collecting premium now for selling options. I think they're selling puts. But the risk that they're taking is just enormous. Because if volatility spikes, they're going to get blown up, and then there's going to be the need for bailouts of hedge funds or whoever. Leverage to the hilt on this leverage short volatility trade. I can almost guarantee you that the size of this leverage short volatility trade is a lot larger than $1.5 trillion in size, because 3 years ago, in 2016 and 17, that was a number that Christopher Cole was quoting, and interest rates are coming down globally. There's so many inverted yield curves globally, and so much zero interest rate policy, negative interest rate policy globally, that other people probably piled onto the trade. I'm looking through listener questions and comments. It could be to keep up the commercial paper market. Remember in 2008, when the commercial paper market froze, we were a handful of days away from no food at the grocery store, because truckers use the commercial paper market, short-term lending, to fund their runs for grocery stores and other goods pickup. What do I think of Jeff Snyder's Eurodollar theory? I think the Eurodollar is nowhere near as important as he says. He says the Eurodollar is only around $16 trillion in size. There's a lot of problems and a lot of markets that are larger than $16 trillion now. So yes, the Eurodollar is important. I've done videos on this. You can look it up in the archives. Yes, it's important, but he makes it like the Eurodollar controls the gold market. The Eurodollar controls the China stock market. He's written articles about how important the Eurodollar is for China and other stuff. He makes it like the Eurodollar is important for everything. And I don't think so. According to him, it's only 16 trillion, which in the whole scheme of things is not that large anymore. I know it sounds large, but 16 trillion is really not that large anymore. No, I don't have a Monero wallet. I have 6 other cryptocurrencies if you want to send me a tip there. The link will be in the information and description section. So thank you very much if you decide to do that. Also, thank you. You could just copy and paste, I guess, the wallet address from Bitcoin, Bitcoin Cash, Litecoin, others. If I talk about crypto anymore, Bill Holter is going to send me a nasty email that I'm a crypto pumper, or write a blog article about me. But thank you very much to my almost, well, actually it is 150 Patreon account contributors. Hopefully it'll be 200 in a couple months. And my dozen or so monthly PayPal contributors. Yeah, Diana, physical gold is very popular in the Vietnamese economy. I think the governments tried to block it. They tried to block importing of gold a number of years ago. I remember seeing articles about it, but I don't think it worked very well. So there was a big gold black market in Vietnam. I'm not sure if the government's still trying to do that. You can be your own central bank. You can be your own central bank, so you don't have to save in fiat currency. You can use fiat currency to pay your bills, obviously, pay your taxes, pay your bills, but you don't have to save in fiat currency. There's a bunch of other alternatives now. Okay, well, I think that's pretty much all I wanted to cover for this short episode. So there's a lot of people now. It's becoming basically consensus, if I could wrap it up quickly, that there will be an announcement as soon as the next Fed meeting, probably by November, the latest, that there will be a new permanent repo facility. And this will precede QE. And we don't know, they're going to tell us there's going to be no proof of this, that the Fed's repo facility is only taking good, quote-unquote good collateral, aka U.S. Treasuries. But the problem is, and I've said this, that the primary dealer banks, if you look it up on charts, you can go and search. If you don't believe me, search ownership of U.S. Treasuries by primary dealer banks. and you'll find charts. And so the primary dealer banks, according to the charts I've seen, the newest ones, only have a little over 300 billion in treasuries. So that's not enough good collateral compared to all the repos that have been done recently. The big spike in them. So something is afoot. Something else is being taken as collateral, in my opinion, other than the treasuries, because unless these large primary dealer banks, they hold a lot more treasuries than we know. So they've been buying a lot of these treasuries. Either the Fed has been handing them the money, or they've been stuffing the treasuries into hold-to-maturity accounts. And so officially, they only have, on their balance sheet, they only have around 300 billion or a little over 300 billion in total U.S. treasuries. But off balance sheet, maybe in a special purpose vehicle, maybe in that hold-to-maturity account that Victor Sperandio has been writing articles about, you can just either look in my archives for the interview I did with Victor last year, and his articles are there, or you can search Victor Sperandio hold to maturity account. And those the banks then may have hundreds of billions or more in treasuries off balance sheet in special purpose vehicles. He says that the hold to maturity accounts, he says that the large banks got the rules changed at the Fed a few years ago, and they don't have to write off any losses as treasuries. So they don't have to mark any of their losses in treasuries down, and it's pure profits for them. What else do they have but treasuries? Banks can own a lot of different stuff. They can have loans. They can own stocks. But normally, primary dealers are expected to buy treasuries. So are U.S. insurance companies. U.S. insurance companies are required by law to own a lot of bonds. Okay, well, that's it for right now. Thank you very much for your time, and I hope you enjoyed this unique content. It's going to keep coming. As long as more money's coming in from Patreon, and my Google AdWords revenues are doing pretty well right now. And unfortunately, my growth in my channel, it was growing at 2,000 new subscribers per month, so hit the like button, and feel free to comment below the video after it's over. But I was growing at 2,000 new subscribers per month for months now, and that just stopped in the last couple weeks. They actually took the growth in my channel down to 0 again. So I think I added all of 100 new subscribers in the last 3 weeks, despite all the new content that I've been creating for you guys. That's unique, that you won't find pretty much anywhere else on the internet, especially for free. You may find some of this stuff behind a paywall on Hedgeye or Real Vision Television. Okay, bye for now.